In this video, I want to discuss why convertible bonds might not be right for you. And in this case, I want to consider the disadvantages of investing in convertible bonds. Number one is limited income potentials. There is that particular limit on what you could gain when it comes to investments in convertible bonds. Convertible bonds generally offer lower interest rates compared to traditional bonds, as the conversion feature compensates for the reduced risk. But the very fact that you may eventually convert your bond to equity, it tends to compensate for the fact that you get less returns, less interest on this particular instrument compared to the regular government issued bonds. So it still boils down to limited, income potentials. Number two is equity dilution for issuers. In this case, when the bonds are converted into stock, it tends to dilute the equity. In other words, it increases the share outstanding of the issuing company. And as we all know, increase in share outstanding, affects the earning per share negatively. And so there's that particular equity dilution for issuers. When bondholders convert their bonds into stock, it increases the number of shares, outstanding, potentially diluting the value of existing shares and reducing the earning per share of that company. And generally, whenever there's a reduction in earning per share, the price most of the times will drop. This is a huge disadvantage, particularly for the company issuing these bonds. Number three is dependence on stock performance. Dependence on stock performance. The value of convertible bonds is closely tied to the performance of the issuing company stocks. All right, and so the value is so dependent on the performance of the shares or the stock of the company issuing these bonds. And so if the stock price does not rise significantly, the conversion option may remain unattractive, reducing the bond's overall appeal. Usually, when people buy convertible bonds, they expect the share of the company to rise so that they can convert their bonds into share and participate in the returns obtainable from an increase in share price of the company. But if the company performs poorly and the stock price does not rise, in that case, the bondholder is forced to hold his bond, collect marginal lower interest rate, which will not really augur well, as regards the overall returns the investor expects from this particular investment. Number four is credit risk. Like any bond, convertible bond, equally carry credit risk. If the issuing company, if the issuer faces financial difficulties, or if the issuing company defaults, investors may lose parts of, if not all of their investments. And so the risk is always there. No investment is risk-free. Even holding cash is not risk-free. You refuse to invest and say, let me hold cash, is still not risk-free, because inflation will eventually eat into your cash position, into your cash holding. And so this particular investment equally carries its own inherent, peculiar kind of risk. Number five is subordination in bankruptcy. Usually, companies do go bankrupt. There's nothing one can do about that. Companies don't survive, don't thrive forever. The environment may come in, environmental factor, political, economic factors may come in and may force the company into poor performance and eventual bankruptcy. And so convertible bonds are often subordinated debts, meaning that they are lower in the repayment hierarchy compared to secured bonds in case of bankruptcy. When the company goes bankrupt, all right, convertible bond holders are not paid immediately. They are paid after secured bondholders have recouped their investments. Whatever remains now goes to our convertible bondholders. What am I talking about? What I mean is that secured bondholders have their bonds. When it comes to that particular agreement, the value of the fund they provide, the security is tied to the company's assets. Let's say the company's plants. Let's say plant and equipment. And so whenever if the company goes bankrupt, they will quickly sell the plants and equipment, and then the secured bondholders will recoup their money, will recover their money. And if anything remains, it will now go to the convertible bondholders. All right. If nothing remains, then of course they will have nothing to go home with. And so they are always subordinates when it comes to disposing, when it comes to sharing profits from the disposal of company assets. Please like this video and subscribe to this channel. Number 6 is market sensitivity. Market sensitivity. Convertible bonds, can be sensitive to changes in interest rates and stock market volatility, potentially causing fluctuation in their market value. Usually, as is the case with all manner of bonds, whenever there's an increase in interest rates, bond values generally drops. All right, and so in this case, you discover that if the underlying company, the underlying company, the issuer of this company, of this bonds does poorly, you discover that the stock of the company will drop, and invariably the value of these convertible bonds will equally drop. So the entire investment is market sensitive, is sensitive to the market or the prevailing market condition. Number 7 is complex valuation. There is that complexity in valuing or ascertaining the value of stocks of these convertible bonds. The hybrid nature of convertible bonds makes them more complex to analyze and value compared to traditional bonds and stocks. So it's quite complex because the value is derived from the environment, the market condition, and the condition of the issuer at that particular point in time. And so number 8 is conversion terms and risk. Conversion terms risk. The specific terms of conversion, example, conversion price or ratio, may be less favorable to investors if not carefully considered at the time of purchase. When you come to conversion, discover that it's not done haphazardly. All right, you may say, well, you have to convert maybe 10 or 5, a unit of bonds to maybe 20 or whatever units of shares. So that conversion ratio is what must be taken into consideration, so that at the point of buying, you will not really, it must favor you as an investor before you buy. Does it favor you? Does it not favor you? You consider it before you talk about investing in convertible bonds. That conversion ratio is very, very important. Is it 2:1? Is it 3:1? Is it 4:1? Whichever the conversion ratio is very important, you take into consideration. Number 9 is call risk. Many convertible bonds are callable, meaning the issuer can redeem it before maturity. If the bond is slated to mature, after, let's say, 4 years or 3 years or 2 years, the issuer can decide to recall it, so redeem it before maturity. And so if the bonds are called, investors may lose out in future interest payment, or the opportunity to convert it to equity, to shares, will then automatically disappear. In the case where the bonds are kind of redeemed, the investor will lose the interest payments and then will not have an opportunity of converting the bonds into stocks as expected. Number 10 is opportunities cost. If the issuing company's stock significantly underperforms, that's serious. Investors may feel they would have been better off investing, directly in high yield bond or other instrument. Nobody can really decide in advance, but all the same, it happens, because when it comes to investing, we have, opportunity cost involved. If it performs poorly, you will have gotten something better, elsewhere. All right, so this is a typical disadvantage one must take into consideration: the opportunity cost of not obtaining, a very good return on your investments.